CMHC and the federal government is looking to investors to continue to help to solve the housing crisis. Really interesting to note because basically investors have been absolute criminals in the eyes of the government for the better part of the last couple of years at this point. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. All right, so unless you were hiding under another tree or you're completely blown away by the nonstop announcements of government rule changes, which honestly I wouldn't be surprised if you are at this point right now, then you might have already heard about the October 8th recent Fed announcement to bring back insured refis. That's right, something that you haven't heard for a long time. And if you're listening to this podcast, you might not even know what insured refinance even is, because it's been that long since we even had them available. The last time we had ability to refinance a mortgage using CMHC insurance was 2016, when the Canucks were 1 year out of the Willie Desjardins-led Canucks to their first return back to the playoffs before a 5-year drought all over again. Now, for not all those non-hockey fans or those listening from different areas of the country, you can ignore all that and just know the fact that we now have the ability to add the potential value of a second dwelling or basement suite up to a maximum of 4 units on a property, up to 90% of the total as complete value. That's pretty significant there. If you think about this from a perspective of someone looking to get into the marketplace and then convert their property into a rental property, there's so many different use case scenarios that you could probably see working out for people to be able to access that potential equity. But before we go any further, you're going to want to wait until the second half of this episode. You're going to want to hang around until then, where I talk a little bit about the proposed outcomes and what this actually could mean for you, as well as some specific scenarios. Plus, the feds are tabling another tax, so we'll talk about what that tax is. So stay along to the end. If you haven't already done so, go ahead and hit that like button on YouTube, or if you're listening to the podcast on audio, go ahead and get that 5-star ratings on Spotify, iTunes. Leave us a fantastic review. It would mean the world to me. Thank you so much. All right. So 90% insured refinance mortgages. Why is it such a big deal? And why are investors freaking out and getting really, really excited about the opportunities that this potentially presents itself? Well, the Canadian government almost essentially created a multifamily residential mortgage refinance program. Now, obviously, a lot of this is going to come down to guidelines and how they're presented. No different than any usual federal government announcement as it relates to mortgages or real estate. They've left out a whole bunch of information that we've got yet to determine, but we can guess and get really excited at this point right now about what this potentially could mean. Now, let's be upfront here. There's no benefit necessarily to a first-time buyer for this particular program, and it probably won't be used by half of the population that already owns homes because they don't want to add a second suite to a property. But for those who want to, on top of the other only few limited refinance construction type of programs, this is a welcome add back into the, CMHC arsenal of mortgage options. So essentially, here's how it breaks down, and here's what you need to know. First and foremost, the refinance funds themselves must be used to construct one or two or more, secondary suites. For example, a laneway house, basement suite, above garage suite, a pool house, anything like that. But it's got to be its own separate suite, which means it has to have its own kitchen, entrance, bathroom, living area, sleeping area, you name it. You have to be able to actually live there. It can't be a room or a part of a room in a house itself. Second thing is, and they haven't specifically broken down exactly how this will be determined, but you can borrow up to 90% of the as complete value of this particular mortgage and construction loan, which is really interesting. Now, again, what will the cost be? Will there be some additional cost for the insurance premiums over and above the typical CMHC premium for a 10% down, which is approximately 3.1% today? The answer to that question, we don't know. But For the sake of conversation, there will be a premium added to the actual property itself. What we don't also know is if you already have paid a premium, is this just a top up? If you haven't paid a premium, are they basing it on the top up balance or the entire amount? It's probably the entire amount, but yet to be determined. Now, the maximum property value is $2 million. Pretty incredible that they decided to go that high, which is interesting, noting that they just went to 1.5 million for the insurable rules when it comes to new mortgages after December 15th. The maximum amortization continues to be 30 years, which makes sense because of the additional money. You have to have the ability to qualify, and the maximum number of units on the property is 4. So you can actually have a total of 4 units on said property. That is very, very interesting news right there. Now, here are the qualification requirements. First and foremost, you must already own your own property, unsurprisingly. Now, there are other programs like Purchase Plus Improvements to be able to add renovation costs to a property. So some of those already exist, but you can't stack it on top of something like this right here. Although I imagine it works relatively similar to the other program. The borrower or a direct family member, I'm assuming a direct family member must be brother, sister, husband, wife, mom, dad, must presently occupy the property or must be occupying the property while the loan is in place. And the unit must be rented out as a long term rental. Again, they don't say for how long this needs to be done, and they don't determine specifically how they'll track that. But based on the army that they have currently at the CRA, I imagine they'll figure out a way to track this, and that'll be interesting to look at. Now, we talked about this before, but it must be its own proper suite. You can't just buy a garden shed and stick a bed in it or something of that nature. And it must conform to municipal zoning requirements. That means your city's zoning requirements itself, which is not surprising and probably a good thing at this point right now. Now, whether or not most of the cities will start to adapt to a lot of the laneway homes and basement suite policies that the provincial and federal governments have been pushing is another question altogether, but we won't be addressing that in today's conversation. Now, the only other thing that you need to know is from a debt to income perspective, because it's an insured mortgage, unsurprisingly, you're required to qualify under 39% of your gross debt service ratio and 44% of your total debt. And so, as far as the usefulness of a property of this nature, it really will come down to property values and those applicants who are on the existing mortgage itself to whether or not they can qualify for the insured mortgage. It's not very often that you see someone taking out $1 million insured mortgage loan. Those people typically have 250 plus $1,000 of family income. But this could make a difference for those who are in that position who've recently purchased those homes and are looking to either keep their existing home for adding a family member or bringing into a multi-generational property, or maybe they're looking at the opportunity to potentially house hack. And I'll talk about that as we go forward. Now, what's interesting to note is that this program can be stacked on top of the secondary suite loan program that was announced earlier this year. Most of the details of this program are still unknown. Like, we actually don't know all the details, but essentially CMHC is going to provide up to $410 million of funding, which will allow people low interest loans to add secondary suites to their properties. What the details of this program are and how someone could stack this to this refinance scenario is yet to be determined because they haven't actually broken that down yet. And for that reason, obviously, we're just going to speculate that there's probably going to be a series of guidelines that are going to make it pretty difficult or make very minimal sense for people to actually use both programs at one place. But it's also interesting to note that we're seeing these programs provincially announced as well. In fact, British Columbia announced a form of a additional suite incentive program earlier this year. So if you think about it, we've got the refinance scenario insured mortgage that we have right now. We have the secondary suite program from the federal government, and then we also have at least one province offering a suite program. They're definitely focusing on creating more and more and more properties within people's existing homes. So the question really is, what does this actually mean from a homeowner's perspective, and where does the market go from here? And I've made some notes to my points in regards to what this could look like and what the market could actually do. But there's no doubt at this point right now, CMHC and the federal government is looking to investors at this point right now to continue to help to solve the housing crisis, which is really interesting to note because basically, quote unquote, investors have been absolute criminals in the eyes of the government for the better part of the last, well, what, couple of years at this point right now, and they're turning to investors to fix the problem, which, suffice to say, is not a surprise from my perspective, but you're basically admitting that people need to become investors to solve the housing crisis. The federal government, the municipalities are not going to be able to do that themselves. So no longer should be the mom and pop investors be looked at as bad guys when it comes to this. But let's go a little bit deeper into the potential outcomes and what this actually could do. So the first one is, well, depending on which province that you're located in, there have been quite a few provinces that have changed and or been in the middle of adjusting a lot of their municipal guidelines around zonings and zoning laws in particular. And we're really looking at BC as one of the primary ones, where essentially they changed the zoning bylaws, where municipalities were essentially forced to be able to convert existing single family detached lots, so lots themselves, to be able to actually put at least four properties or four units on a single lot, depending on the size of that lot in different municipalities. Now, for more about that, you can watch one of the previous videos, but for the sake of conversation, this is looking at a way to utilize some of the benefits of that. The second thing that we're looking at from our perspective is the ability to debt service, potentially looking at that rental income. But let's put this all in context really quickly. Now, a lot of the CMHC rules in the past couple of years have not been very friendly as it relates to rental income in a property itself. In fact, they've essentially all but done away with any type of offset when it comes to an insured mortgage, which basically means that rental income doesn't count for nearly as much in qualification as it used to in the past. So, to be more specific on that, let's look at the actual current rules. Now, most of the typical lenders and pretty much all of the guidelines that you'll find online now show the current rules when it comes to insured mortgages. You can add back up to 50% of the potential rental income from a property with an insured mortgage in almost all scenarios. Now, that doesn't really count for much in the way of providing a boost when it comes to qualification, which is really the biggest challenge that people face today. But the question that I have to ask is, with a program like this, knowing that people will have a little bit more trouble qualifying on their income and knowing that the government doesn't necessarily want to remove the stress test, does something like the 100% add back rule come back into place? What this basically means is they would take 100% of the rental income, so let's say $1,500 a month, and they would add that back to your income, and the equivalent, in this case, $18,000, would boost your qualification, as opposed to the current rules where we can take 50% of that, which works out to about 9,000. Therefore, providing someone with the ability to qualify for essentially 80,000 instead of $40,000 of additional mortgage money when it comes to their overall qualification scenario. Now, those numbers are subjective to what the rates are in the marketplace and someone's personal financial situation, but that's a rough estimate. It could double up, and I wouldn't be surprised to see the lenders bang their drums and suggest they should be allowing a higher rental allowance, if not only for the fact to be able to allow people the ability to take advantage of a program like this. Now, another intended or unintended outcome of this program is likely the opportunity for a lot of home buyers to essentially start to attack and consider the possibility of more multifamily or multi-generational families in homes. Now, we've seen the increase in the amount of multi-generational mom, kids, dad, kids, grandparents, kids buy and move together in the better part of the last couple of years, but there haven't been any programs to allow these people to renovate and add proper suites. And so you still see a lot of people in in-law suites or having to move into a house, therefore potentially increasing the value of the house that already is suited. Does this put people in a position where they can just increase the value and remain in the house that they're at today, as opposed to looking at different properties? That's a good question to ask. And I think the bigger question here is, do we see more laneway homes than we have in the past? And are we going to see more cities adopt these laneway homes? Because for a lot of the more dense cities like Vancouver and many of the cities around Canada, there's a lot of opportunity to create density by using some of the space in the backyards instead of building just straight up to the sky, adding a second or even potentially a third unit in those properties. Now, the other takeaway that I would look at from this particular program, or the other big consideration, is actually really the whole idea of house hacking. And depending on which side of the ledger you're on, I was reading an article about this the other day where some were saying essentially this program itself is going to be essentially exploited and people will be refinance the properties, renting them out, and then moving into the next property and doing the same thing all over again. I don't know if that's going to be a very, very common purpose, but I do think that there will be some people starting to do that. And the question that I ask when it comes to that is that really such a bad thing if people opted to do so? The reality is probably not, but is it going to have the intended consequence of helping family members remain in their existing homes or bring people into those particular properties? I would say yes and yes. Realistically, when it comes to a program like this, there's going to be people out there who are looking to exploit for their benefit. But I mean, I have to guess, or you have to guess, that the federal government most likely consulted at least a few people making these decisions. And I'm sure at least somebody brought up the fact that there would be an opportunity for someone to essentially create multi unit housing from an investment perspective on these properties. And can you blame them? They're, first of all, creating more density in their existing neighborhoods. They're also doing a benefit by creating more potential rental properties for these homes. In addition to that, they're also doing so under the insured programs. Now, whether or not they should be using CMHC insurance to do that is another question altogether. But again, I can't see this as being a negative, unlike what some of the programs or some of the people out there are suggesting. Some other criticism of the program itself really comes down to the fact that there's a lot of cities out there who will probably not even allow for much in the way of density. For example, in areas like Toronto, there's a lot of what they call NIMBYism out there, where people are not actually allowing or any changes in their particular areas or neighborhoods and or cities. And the question mark is, does this change or have an impact on the evolution of how cities and municipalities look at, let's say, laneway homes or secondary housing in place? Now, I don't know the answer to that. I can only imagine that's going to be a slow grind. And I don't think that this type of a change or CMHC change will really necessarily actually impact those types of considerations. But I do think it's worth considering the fact that that is a reality, and this could force more people to think more creatively. Like, if you think about it from a context perspective, a lot of these downtown cities and cores, they're going to see one of two things. You're either going to tear down your neighborhood and put up a condo building there, or they're going to open up to the idea of adding multiple suites on properties and or laneway homes, which in my opinion is a better decision mid to long term. But we'll have to wait and see what that looks like. So what I'd be curious to know is, what are your thoughts on these types of programs? Do you think this is something that's going to have a meaningful impact, the ability to refinance to add a secondary suite to a property? Will it change the way that people approach living in their homes or keeping their existing properties? Or do you think it will just end up being a house hacker's dream to be able to add multiple units, and you're going to see people essentially converting single family homes into multi-unit properties using CMHC and then moving on to the next property? Love to hear the feedback below in the comments, or if you're on social media, send me a message on Instagram. But before we end the call, we got to get into the taxes I was mentioning before. And this is some interesting news, because Freeland also mentioned that the Canadian Liberals are thinking about the possibility of a completely new tax on vacant land. That's right. Not only are they taxing underutilized homes, they're thinking about the opportunity to tax vacant land, which you have to only guess is a terrible idea. Like, what do we need another tax at this point right now? We actually need action, not taxes. But a couple of thoughts when it comes to the vacant tax rules at this point right now. First and foremost, we talked about the fact that there's a 1% annual underused housing tax that kicked off in January of 2022, which has completely done nothing to the eyes of myself and or any of the research that we can find for anyone, except for being more of a hindrance and a tax. The question mark is, where does that money even go, and has it made any difference? Chances are probably not likely that anyone has at this point right now. The other thought is, this just another cost that basically converts in the developers looking at their overall costs and passing this on to the homeowners? The answer to that question is 100% yes. You're taxing the developers and the landowners, and that's going to get passed on to the potential buyers at some point in the future. So what's the real benefit of that? There was also a notice of this in an article that I was reading about the fact that, and I don't have a lot of experience in this reference, so I'm just going to bring it up so you can do some research on this, but reducing or having meaningful effect on land availability over time, meaning the tax itself basically had no effect on any land availability over time, as was seen in Ireland and South Africa, most notably. Specifically, there's a quote here that talks about Ireland in its development land in the 1970s. It cost more to administer the tax itself than it yielded, and it actually caused land development to dry up for years, according to a few different of the property advisors quoted, Cook and Arkwright. So essentially, the tax itself stopped people from wanting to buy and hold vacant land, which negatively impacted the land values and negatively impacted the willingness for a developer to develop on the land itself. And it also increased the cost of the development. So by no means does this look like it will be a benefit to any consumer out there. But as you know, our government is about taxing taxes on top of taxes and taxes. So I'd love to hear feedback from you on that. Do you think that this has any potential positive outcome, or is this just a complete joke that is going to be another tax? Between the CMHC 30-year amortization, the $1.5 million, the 30 years for new development properties and first-time buyers on anything, the refinances, one thing is for certain: when you consider all these different kinds of rules and guideline changes right now, the government is looking to stoke the fire. But the big question that remains to be asked, and we'll answer this in another episode, is when will they get rid of or change the stress test? Because that is the one thing that will allow first-time buyers and home buyers to get into the marketplace. One thing is to be certain at this point right now: demand is going to increase and supply is still dwindling. Let me know if you have any other questions or feedback in the channels below. We'll see you guys on the next one.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.